Ever wondered why the government can't just print more money to solve financial crises? It's a question that has crossed the minds of many, especially when the news headlines are dominated by massive aid packages and stimulus measures. The notion of just print more money seems like an easy solution, doesn't it? But in reality, the intricacies of financial strategy, particularly in the United States, are far more complex. Today, we'll be exploring this very topic, debunking the myth of just print money and shedding light on the multifaceted nature of US economic policy. We'll delve into the world of reserve currencies, quantitative easing, and the risks associated with overprinting. We'll also navigate the strategic financial aid landscape and the fiscal puzzle of funding these initiatives. So, strap in for an enlightening journey through the maze of US financial strategy. Let's dive deeper into this fascinating subject. First, we need to understand the role of the US dollar as a reserve currency. Picture the global economy as an intricate web of transactions, with the US dollar at its heart, connecting various economies. A reserve currency is the one that central banks across the globe hold in significant quantities. It's the currency they use to conduct their international transactions. Now, why is the US dollar the world's primary reserve currency? It's because of the sheer size and strength of the US economy and the confidence that the world has in its stability. This status comes with a few perks. One of the main advantages is lower borrowing costs. Since the world is willing to lend in dollars, the US can borrow at lower interest rates. Imagine having a credit card with an unbelievably low interest rate because everyone trusts you'll pay it back. That's the US with its dollar. Another advantage is economic stability. The demand for dollars worldwide helps the US maintain a stable economy. Even in times of economic downturns, the demand for the dollar rarely wanes, providing a safety net for the US economy. Also, the US can effectively manage its trade deficits due to the dollar's reserve currency status. It can import goods and services from other countries and pay in dollars, which are eagerly accepted worldwide. But of course, with great power comes great responsibility. The US must ensure that the dollar maintains its value and credibility. It can't just print money recklessly, as that would lead to inflation and a loss of confidence in the dollar. And that's where the delicate dance of economic policy comes in. So the dollar's status is key, but how is it maintained? Well, that's a whole other story of strategy, diplomacy, and yes, a bit of economic wizardry, which we'll delve into as we proceed. So buckle up as we navigate through the fascinating world of US financial strategy. This brings us to an important tool in financial strategy, quantitative easing. Now, you might be thinking, that sounds like a mouthful, but let's break it down into simpler terms. Quantitative easing, or QE for short, is not your traditional money printing. In fact, it's a bit more nuanced than that. The Federal Reserve, the US's central bank, uses QE as a strategy to stimulate the economy, especially in times of financial crisis. So, how does it work? Well, imagine the economy as a giant pot of soup. The Federal Reserve, acting as the chef, stirs the pot to keep it from boiling over or cooling down too much. In this case, the stirring is done through buying and selling government bonds, which in turn influences the amount of money circulating in the economy. When the Federal Reserve buys these bonds, it's essentially injecting money into the economy. This increases the money supply, which encourages banks to lend more. As a result, businesses can borrow more easily to invest and expand, and consumers have more money to spend. This increased spending can stimulate economic growth. But here's the key difference between QE and traditional money printing. The money created through QE isn't meant to stay in the economy forever. It's more like a loan. Once the economy is back on its feet, the Federal Reserve sells the bonds it bought earlier. This takes money out of the economy, essentially paying back the money that was created. Now you might be wondering, why doesn't the Federal Reserve just print more money? Well, that's where things get interesting. The Federal Reserve's role isn't just to manage the money supply, it's also to maintain the value of the dollar. If the Federal Reserve simply printed more money without a plan to take it back out of the economy, it could lead to inflation or a decrease in the purchasing power of the dollar. In other words, if there's too much money chasing too few goods, the price of those goods can go up. That's why the Federal Reserve has to tread carefully when it comes to QE. It's a balancing act where they have to ensure that there's enough money to stimulate the economy, but not so much that it causes inflation. So, QE isn't just about printing money, it's a strategy that involves careful timing, precision, and a deep understanding of economic indicators. It's about creating the right conditions for economic growth, while also preserving the value of the dollar. However, this strategy comes with its own set of risks. Let's delve into some of those in the next scene as we explore the potential dangers of overprinting and the looming shadow of inflation. The most significant risk of overprinting: inflation. But what is inflation, you might ask? In simple terms, inflation is the rate at which the general level of prices for goods and services is rising and subsequently, purchasing power is falling. Central banks attempt to limit inflation and avoid deflation to keep the economy running smoothly. Now, let's talk about the elephant in the room: overprinting. When a government prints money excessively, more money chases the same amount of goods and services in an economy. This excess demand pushes up prices, leading to inflation. And while a moderate level of inflation is a sign of a healthy economy, excessive inflation can be harmful. It erodes the value of money, as the same amount of cash buys fewer goods and services. This can particularly hurt those living on fixed incomes, such as retirees, as their purchasing power declines. Let's delve into some real-world examples. Consider the Weimar Republic in Germany after World War I, or Zimbabwe in the early 2000s. Both nations printed money excessively to meet their financial obligations, leading to hyperinflation. In Zimbabwe's case, at its peak, prices were almost doubling every day, making the nation's currency virtually worthless. In the US, the Federal Reserve, the nation's central bank, has the critical task of controlling inflation. It uses various tools, such as setting interest rates and regulating the money supply, to keep inflation at an optimal level, typically around 2% per year. However, it's a delicate balancing act. Too little money in the system can stifle economic growth, leading to unemployment and recession. Too much, on the other hand, can lead to runaway inflation, eroding people's purchasing power and potentially leading to economic instability. So, the next time you hear someone say, "Why can't the government just print more money?" remember the intricate dance of economic policies that go into maintaining a stable, healthy economy. But what about when we need to provide financial aid to other countries? Consider the recent $95 billion aid package and its strategic importance. It's more than a mere financial transaction. It's a powerful tool of diplomacy, a way of strengthening alliances and fostering stability in regions of strategic interest to the United States. Take Taiwan, for instance. This small island nation, a technological powerhouse, is a key player in the global supply chain of semiconductors. By aiding Taiwan, the US not only bolsters an ally, but also secures its own technological future. Then there's Israel, a beacon of democracy in the Middle East. The US financial support to Israel serves to fortify a key ally in a region characterized by volatility. This not only safeguards Israel's security, but also indirectly bolsters US's own strategic positioning in the region. Finally, let's turn to Ukraine. The US aid to Ukraine is a clear demonstration of support in the face of Russian aggression. This aid, a mix of military and economic support, helps Ukraine maintain its sovereignty while sending a strong message to other global powers. So, you see, the $95 billion aid package is not just about doling out dollars. It's about strategic investments that serve US geopolitical interests. These aid packages are a testament to the power of financial diplomacy, where money is used not just to build bridges and roads, but to forge alliances, uphold principles of democracy, and maintain a balance of power. But aid packages, while strategically important, are not without cost. The question that naturally arises is, how does the US manage to fund these initiatives? The answer to this question takes us to the heart of the fiscal puzzle that every nation grapples with. Now, how do we fund these aid initiatives? The fiscal puzzle involves budget reallocations and increasing national debt. This statement rings true when we delve into the intricate mechanisms of how the United States funds its aid initiatives. A significant chunk of funding for aid initiatives comes from the reallocation of budget resources. The US government, like any other, operates on a budget. This budget is a fiscal plan that details the intended revenues and expenditures for a particular period. The government can decide to shift funds from one area to another based on its priorities. And in this case, international aid is often a major focus. However, budget reallocation is not as simple as moving money from one pocket to another. It's a complex process that requires careful consideration of the potential impact on the areas from which funds are being redirected. This could mean less money for domestic programs, affecting citizens in the short term. But the long-term benefits of strategic aid could outweigh these temporary setbacks, fostering international relations and global stability. On the other hand, increasing the national debt is another way the US funds its aid initiatives. Borrowing money, often in the form of issuing government bonds, allows the US to finance its expenditures without immediately impacting the domestic economy. However, it's a double-edged sword. While borrowing allows for immediate funding, it also means future generations will be saddled with the responsibility of paying off this debt. Increasing national debt has its own implications. It could potentially lead to higher interest rates, which would make future borrowing more expensive. It could also lead to inflation if not properly managed. However, as the world's leading economy and the issuer of the global reserve currency, the US has been able to manage its debt levels effectively so far. So, it's clear that economic policy is a delicate balancing act. The US must navigate the fiscal puzzle, balancing the need for strategic aid with the realities of budget constraints and debt management. It's not merely about just printing money, but a complex dance of financial strategy, geopolitical considerations, and long-term economic planning. The just print money strategy is overly simplistic and potentially harmful. This statement has emerged as a common refrain throughout our exploration of US financial strategies, and for good reason. Economic policy is a delicate balancing act. It's a game of chess on a global scale where a single move can ripple outwards, leading to consequences far beyond the borders of a single nation. The United States, with its dollar as the world's reserve currency, is a key player in this game. Its financial decisions, from quantitative easing to foreign aid packages, have far-reaching implications. These decisions are not made lightly, nor are they as simple as turning on a money printing press. When the US chooses to inject money into its economy, it's not simply creating wealth out of thin air. It's a strategic move aimed at stimulating economic activity. It's a calculated risk taken with the understanding that overprinting can lead to inflation, a phenomenon that erodes the purchasing power of every dollar in circulation. When the US extends financial aid to countries like Taiwan, Israel, and Ukraine, it's not just writing a check, it's making a strategic investment, one that serves its geopolitical interests and contributes to global stability. And when the US increases its national debt to fund these initiatives, it's not just borrowing money, it's making a bet on its future, a statement of faith in its economic resilience and the enduring strength of its dollar. The balance of economic policy is a continuous dance, a series of careful steps taken with an eye on the bigger picture. It's a dance that requires foresight, flexibility, and a deep understanding of the interconnectedness of global economies. So the next time you hear someone say, "Why doesn't the US just print more money?" remember that the answer is not as simple as it seems. It's a dance, a balance, a game of chess, and it's one that the US plays with the world watching. We hope this has shed light on the intricacies of US financial strategy. Economic decisions are complex and far-reaching. They're not just about numbers on a page, but about people and their livelihoods. They're about the stability of nations and the balance of global power. They're about the fine line between growth and risk, between aiding allies and accruing debt. The intricacies of US financial strategy, as we've explored, debunk the just print money myth. It's a delicate dance of quantitative easing, managing inflation risks, and strategic financial aid. It's about leveraging the power of the US dollar as a reserve currency, while carefully navigating the potential pitfalls of overprinting. But what's your take on this? Do these strategies make economic sense to you? Do you perceive them as astute moves or risky gambles? You're invited to share your thoughts, analyses, and questions in the comments section below. Thank you for watching. Subscribe for more insightful content on economic policies.